This video is part of the ICT One Trading Setup for Life series, where I go over setups and strategies that ICT recommends in one of his videos titled ICT One Trading Setup for Life. I'll be covering 3 setups in this series in a simple way, so make sure to watch the other videos. This video, I'll be going over the opening range gap model. It's an easy to understand model, yet so effective and powerful and profitable. If anyone needs a one-on-one mentorship, check out the description. This is Molham, and let's get into it. So starting as always with a pair, this is mainly on indices. This setup, I would be recommending to only use S&P 500. It doesn't work on forex. Why? Because there's no gap. It only works on indices and mainly S&P 500. So stick to S&P 500 to get the highest win rate. Now, first of all, it's an opening range gap model, but we need to understand what is an opening range gap. It's a gap that is formed as a result of all of the overnight trading hours being filtered out when using the regular trading hours ETH chart on TradingView. And it forms from the end of the session, the previous session, to the 9:30 open. And it's always EST, as you know. It is marked from the closing price of the previous session to the opening price of the 9:30 a.m. open. If we go and take example on how to draw the opening range gap, so this is the 1-minute chart. What do we see here? This is a bearish candle, which means that it opened here and it closed here, and this is the highest point, but the closing was here. That's why it's bearish. When it's bearish, the closing is at the low. So this is the closing of the candle. We start from here, we go up to where? To the open of the 9:30. You can see that since this is a bullish candle, where does it open? Right here. So this is our opening range gap in this case, from this low to this low of a candle. In this case, this is a bullish candle. Where does it close? Up here. High of this candle all the way to where? This is a bearish candle, which means that it closes here. But we are looking for the opening of this candle, which is right here. So my opening range gap is from this high of a candle to this high of the candle, right? Or this body high of the candle, actually. So this is my opening range gap. And you can see that 50% of this got respected. Price went up. The same thing here. Price was going lower. 50% respected. Price went up. And in this strategy, we'll be focusing more on variation 1, but there was another variation that you could use sometime. But all of the examples that I'm going to be covering today, and the way that I use the opening range gap, it's the variation 1. This is how I use it. So we're going to be using the regular trading hours, and at 9:30 to the previous session, this is after the PM session, there would be a gap here, right? This gap, and it depends on what time frame you're using. I cannot specify a specific time, but you're going to be seeing it here on the regular trading hours. Today's video is sponsored by Hanko Trade, one of the best brokers in the business with spread as low as 0, low commission, and you can trade all markets, including forex, indices, and crypto. And if you use the link in the description, you will get an exclusive 100% bonus. Make sure not to miss it. Let's get back to the video. So if we could identify a bullish order flow and then price started to go up, and at the closing of the previous session and at the 9:30 open, we could see that there is a gap to the upside. This is a bullish gap, which means that there was an aggressive move in the overnight trading and price just shoots up here. The opening of the market was up here. This opening range gap can be used the same as an efficiency, the same as a fair value gap. So this could be the same as a fair value gap here. There is an efficiency in price, where price wants to go up and fill this fair value gap or opening range gap. This opening range gap would mostly be filled. And if we have a liquidity level right here, and we could identify the bias as price still going up and there is a draw on liquidity right here, we can wait for price to come into the 50% of the opening range gap. And this would be like a magnet. This 50% of the opening range gap would be acting like a magnet. We could wait for price to come into the 50%, show a reaction, give me a fair value gap or any type of entry, I would be entering from here going up. This is how we're going to be doing it. And this is the variation 1, but everything is going to be more clear when I go over the example. The second variation is going to be a little bit different. Still, we have the opening range gap here. The bias was going up. Price started here, did not fill the opening range gap, which we know that is going to be filled. Sooner or later, it's going to be filled. But what happened is price going up, taking a buy side liquidity, give me an entry. If I see a tab of entry to the downside and it looks like, oh, the market is turning bearish in this case, what I can do is enter from this fair value gap right here, targeting what? 50% of the opening range gap. And why? Because it's still a magnet to price. Price will still fill that opening range gap. So I could enter here targeting this, and this would be a fair value gap. We know that fair value gaps are internal liquidity. So this is actually a liquidity level that I can target. So this is the variation 2. But as I said, we're going to be putting all of the focus into variation 1 because in my opinion, it's easier to spot. This one is not easy to spot. The variation 1 is much easier to spot, and it's also a high probability one. So what are the steps for the variation 1? First, we start by identifying the bias and the draw on liquidity. Then you ask yourself this question: does it make sense for price to go into that direction? And what direction? The direction of the opening range gap. If it closes up, or the opening range gap opens up, which means that it's a bullish one, doesn't make sense for price to still go up above the opening range gap? If yes, then we wait for price to retraces back into the opening range gap and we look for an entry type, for example, fair value gap with displacement or any other type of entry. Looking at some examples here, and from this point, everything is going to be more clear. This is the 1 minute chart. From this point, everything is going to be more clear. This is the 1 minute chart, S&P 500. What do we see? Can see that we draw our opening range gap. Price started going up, still going up, then started to go lower. Doesn't make sense for price to go and take this high. Yes, as we can see, a very big opening to the upside. Price is going up. The order flow was going up. I could not show more of the chart here, but it did not take a main liquidity level or buy side liquidity. Price started going into the opening range gap. It did not go to the 50%, but it was so close to it. When we see this, what do we notice? From all of the move right here, we can see that we did not have a candle as big as this one. This is a big candle compared to all of the candles in this leg right here. And even right here, all the way down. This is the biggest candle. It created an order block right here and also a fair value gap. This is the change in the state of delivery. We had an inducement here. So this is inducement and fair value gap entry. We could just simply, we could see the displacement right here. Price starting to go lower. We can also apply the OTE, and I'm sure it's on the OTE zone. This fair value gap, we could enter from immediately. Stop loss below the low. Targeting what? Mainly, I would be targeting the high created after the opening range gap, or simply if price after creating the opening range gap, it went lower, I'll be targeting that high immediately after the opening of the opening range gap. So in this case, it's this high. This is the highest high, and we can always look for this shape going up, retracing down, and then a breakout structure to the upside. This is a 5.5 reward to risk trade. You could simply enter from the order block also, or the fair value gap and inducement. This is a higher probability entry. Targeting the buy side liquidity, you can see that price went up, back again into the entry. See how it's respecting the entry, going up and taking the buy side liquidity. And you see how it's also respecting that liquidity level. The other example right here, we can see that this is my opening range gap to the downside and price is going lower. And we have a breakout structure here, another breakout structure here, but this is not the highest probability one, but there is one here. Breakout structure in this leg right here, we can see a fair value gap. It's the only fair value gap we have in this leg. Price started going lower. Price already kind of respected the 50% of the opening range gap. It was very close to it. Started going lower, breakout structure, going lower, then started going up. What do we see here? We can see that we have a fair value gap here after breakout structure. So this is a high probability one. We could simply enter from here, stop loss above the high. And what do we target? We target the sell side liquidity, or basically the lowest low that was created after the opening range gap. So we have the opening range gap. This is the lowest low. Price went to my entry. What do we target? This low right here. And this is the low hanging fruit here. So I'll be targeting this. This is 2.5 reward to risk. However, another confluence that you can do, and this is told by ICT, what you can do is target standard deviations of the opening range gap. So this is the opening range gap. If I take my fib and have the settings at 0, 1, -1, and -2, we can measure this opening range gap, take the -1 and have the standard deviation of -1 and -2. We could target those, and you can see the first target, the -1 is right here. This is the -1. -2 is right here. So if you target the -2 standard deviation, target hit here, it would be a 4.5 reward to risk. So you could use the standard deviation to measure your targets and to get a higher take profit. And another example right here with a much bigger opening range gap. This is a very big opening range gap. You can see the price was going lower, respected a fair value gap here, price going lower, now going up, no entry at all. We don't see any entry right here. Price started going lower, up, sweep, coming lower here. We have a market structure shift at this point with a big displacement. This tells you that, oh, we have price coming lower. We have a change of character. Now we can measure the leg from this high to this low, and we can see that this fair value gap right here, which is the extreme one, is at OTE. The OTE fair value gap, market structure shift, displacement, price already went above the 50% of the opening range gap. This is a high probability entry. Simply entering from the fair value gap, targeting what? The lowest low after the opening range gap. Opening range gap here. This is the low. Price started going up. Entry here. What is the lowest low after the opening range gap? This one. And this one was hit. This is a 2.5. This had a lot of confluences here. Market structure shift, displacement, fair value gap, OTE, as well as inducement. And also price was already above the 50% of the opening range gap, which is a high probability thing. Last example, and as we said, price respected a fair value gap here before the opening range gap, which means that price wanted to go lower, and big opening range gap after that. Price came into the 50%, created a fair value gap here. Did we have an entry? No. So that's the point of this example. Not every time we would be having an entry inside of the opening range gap, which means that we don't force. We don't think that, oh, there is a guaranteed trade every day using this setup. No. If we find a setup that has all of the confluences that we look for, we enter. Otherwise, even if price respected, in this case, respected the 50%, clearly here, no entry, we don't enter. We don't force trades. Going over some tips to get even a higher win rate. First of all, if price respected a fair value gap before the creation of the opening range gap and in the same direction, this is a higher probability, which means that imagine that we have, same as the last example, we had a bearish fair value gap before price creating the opening range gap. It respected that bearish fair value gap, started going lower, and we opened with a very bearish opening range gap. This tells me that mostly this opening range gap would hold. Why? Because it's the same as a fair value gap created after a fair value gap. It's the same thing. So we have two things supporting price to go lower. Also, your entry above the 50% of the opening range gap is a high probability thing, as well as you don't want to see 9:30 a.m. taking a major liquidity level. And if it does, price will most likely not respect the opening range gap. So be careful of the 9:30 open taking a major liquidity level. If it does, most likely it's not going to be the highest probability entry or the highest probability trade. This is it for this video, and actually this is it for the series. I covered 3 setups. This is the last video of the series. If you guys like this type of content, make sure to hit the like button, subscribe to the channel, leave a comment with other ideas or series that you want me to go over or, make videos about. This is Mulham, and I'll see you in the next video.